Alright, if you care about markets, stay with me for a minute because something just shifted and most people are already late to noticing it. This isn't a chart trick or social media hype. This just happened. A 25% tariff announcement out of Washington hit the wires, and within hours you could see stress ripple through global trade assumptions. What's wild is where the signal is coming from. It's not stocks, it's not crypto, it's silver. And no, this move isn't about Reddit speculation or shiny metal hype. The real trigger is structural, and it's telling you something uncomfortable about where the global system is heading. I'm going to show you what's happening right now, why silver reacted the way it did, and how you can spot this pattern yourself next time, before the headlines catch up. Before I explain what caused this reaction, let me teach you something most people miss about silver. People love to argue whether it's a precious metal or an industrial metal, but that argument misses the point entirely. Silver is both at the same time all the time. Think of it like a smoke detector in a building that's also wired into the power grid. When confidence is high and trade flows smoothly, silver behaves like an input cost. It's just another commodity on the balance sheet. When confidence cracks, silver behaves like insurance. People reach for it. And when both pressures hit at once, when industrial demand stays strong but monetary trust erodes, silver doesn't whisper. It screams. That's why you can't analyze silver the way you analyze gold, and you definitely can't analyze it the way you analyze a meme stock or some tech play. When supply chains wobble and monetary trust erodes together, silver reacts faster than almost anything else you can watch. It's telling you something about the system itself. So what does that tell us? It tells us that silver is a diagnostic tool. It's not just an asset you trade or stack. It's a real-time gauge of how much friction exists between industrial reality and financial confidence. And right now that gauge is moving. If this is making sense so far, drop a comment below and let me know if you've been watching silver or if this is new territory for you. Because what I'm about to show you next is where the mechanics get really interesting. Now here's what's actually happening. Let me break down the sequence because this is where the market mechanics matter. When Donald Trump announced a 25% tariff on South Korea, this wasn't just a political headline for the news cycle. This immediately repriced assumptions around autos, electronics, pharmaceuticals, and advanced manufacturing. Those industries don't just absorb tariffs and move on. They can't. They pass costs forward, they delay investment decisions, and they start scrambling for alternatives. That raises production costs. At the same time, it reduces visibility on future planning. So when tariffs hit, you get a double shock running through the system. First, inflationary pressure creeps into the cost structure. Input costs rise, margins compress, and companies have to decide who eats that cost. Second, confidence in the stability of global trade takes a hit. If tariffs can appear overnight, what else can change? That uncertainty freezes capital. That's the cascade. And here's what's wild about it. Silver sits right at the intersection of those forces. It's a critical industrial input for electronics, solar panels, medical devices, and energy infrastructure. You can't easily substitute it out, but it's also a hedge against monetary stress. It's one of the few assets that functions in both worlds simultaneously. So when tariffs inject friction into supply chains, industrial demand doesn't vanish overnight. Companies still need silver to manufacture products. But financial demand wakes up hard. Investors start asking what happens if trade wars escalate, if inflation picks up again, if the dollar's role shifts. And silver catches both waves at once. But here's the part that should make you nervous. This isn't a one-off policy move that gets walked back in a week. This signals a deeper shift from cooperative trade frameworks to leverage-based trade relationships. And markets don't just price headlines, they price regimes, they price the underlying rules of the game. When those rules change, when the framework shifts from "we all benefit from open trade" to "we're using tariffs as negotiating weapons," that's not noise, that's signal. And silver's reaction isn't random. It's telling you the market is repricing what kind of world we're moving into. Now let me show you what very few people are talking about right now. The mechanics here aren't just theoretical. They're showing up in real positioning data. When tariffs hit, you don't just see speculators buying silver futures for a quick trade. You see industrial buyers securing supply earlier than they normally would because they're worried about price volatility or availability. You see pension funds and institutional allocators quietly increasing precious metals exposure because their risk models are flagging trade uncertainty. And you see physical demand from individuals who've been through this pattern before and know how it plays out. All three of those flows are happening right now. They're not coordinated, they're convergent. And that convergence is what creates the explosive move, not just hype. Zoom out for a second, because this pattern isn't new. We've seen this movie before, and the script is familiar if you know where to look. This is the exact same playbook we saw during the 1930 Smoot-Hawley tariff era, when protectionism tightened global trade and precious metals surged as confidence in the international system broke down. Countries started hoarding gold and silver as trust in cross-border commerce collapsed. It echoed again in the 1970s when supply shocks and geopolitical stress pushed silver into explosive moves that caught most investors completely flat-footed. Silver went from under $6 an ounce to over $50 in less than 2 years. Same pattern. Trade disruption plus monetary uncertainty equals silver surge. And more recently, during the 2018 to 2020 trade war environment, silver consistently front-ran broader economic stress signals. When Trump launched tariffs on China, silver started moving before stocks fully priced in the implications. It wasn't because silver traders are smarter, it's because silver is structurally positioned to react first when trade and monetary confidence collide. Every time this combination appears, trade friction plus monetary uncertainty, silver doesn't move because people get excited about a Reddit post. It moves because the system is under strain. When you look at the pattern across decades, silver acts less like a commodity and more like a stress gauge for the global economic order. The larger story here is this: when global trust erodes, silver prices stop being polite. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this be a temporary spike that fades in 2 weeks? Absolutely. Could speculators be amplifying the move and creating artificial momentum? Of course they could. Markets always overshoot in the short term. That's not new. Could this be some coordinated manipulation or conspiracy? Maybe. I'm not going to sit here and tell you markets are perfectly efficient or that powerful players don't exist. But here's the thing. It doesn't actually matter whether you believe in manipulation or not. That debate is a distraction. The mechanics are what matter. Tariffs don't vanish overnight. Supply chains don't reroute instantly. And confidence, once it's cracked, doesn't heal quickly. Those are structural realities, not opinions. So instead of arguing about motives or who's pulling strings, focus on what's changing underneath the price action, not who's tweeting about it or what some anonymous account is claiming. Watch cause and effect. That's what you can actually verify. There are probably 3 types of people watching this right now, and I want to speak to each of you directly because your situation matters. If you're a trader, you're asking how fast this can move and where volatility clusters. You want to know if this is a scalp or a position trade. For you, silver isn't a belief system, it's a vehicle. And here's what I'd tell you. Respect the speed. This isn't a slow-moving trend you can check once a day. Silver can gap overnight. It can move 5% in an hour. Size your risk accordingly and watch liquidity closely. Don't get cute trying to pick exact tops. The best traders I know use volatility to their advantage, but they never fight momentum just because something feels overbought. If you're a long-term investor, you might be rolling your eyes right now, thinking you've seen silver hype before and it always fades. That's fair. You've probably watched silver spike in 2011 in 2020, and you've seen people get burned chasing it. I get the skepticism, but your job as a long-term investor isn't to predict tops or bottoms. It's to recognize regime shifts early and decide if your portfolio actually reflects the world you're living in. If global trade is fragmenting, if monetary policy is trapped between inflation and recession, if geopolitical tensions are rising, does your allocation account for that? You don't have to go all in on silver. But ignoring structural shifts because you're tired of hearing about precious metals is its own form of risk. And if you're newer to markets, feeling overwhelmed by all of this, here's your takeaway. Don't chase price. Watch cause and effect. Tariffs, then supply chain disruption, then confidence erosion, then price movement. That sequence matters for everyone, not just for silver. Learn to identify the dominoes before they fall. This is pattern recognition, and it applies to every asset class you'll ever trade or invest in. So here's what I want you to answer in the comments. Which of those 3 describes you best? Are you trading this, holding long-term, or trying to learn how to spot these patterns? Let me know, because that'll help me understand what content serves you best going forward. Here's where I stand personally. I'm not calling for panic, and I'm not pitching fantasy price targets for clicks. I'm paying attention, and I'm watching specific things unfold. Let me tell you what I'm personally watching right now. First, I'm watching how long this tariff language sticks without negotiation or walkback. If this is just posturing that gets softened in a week, that's one scenario. If this becomes entrenched policy with no resolution, that's a different world entirely. Second, I'm watching industrial demand data versus investment flows into silver. If industrial demand starts weakening, but investment flows stay strong, that tells you this is purely a safe haven play. If both stay strong, that tells you the dual nature of silver is fully activated. Third, I'm monitoring bond markets because they quietly confirm whether this stress is spreading beyond commodities. If yields stay calm, maybe this is isolated. If yields start moving erratically, that's your confirmation that systemic stress is building. Based on my analysis, this tariff move wasn't random emotional noise from a politician trying to score points. It was structural. It was a signal about how global trade relationships are being redefined in real time. The fundamental picture for silver hasn't broken. It's being validated. Industrial demand remains strong because you can't electrify the world or build advanced electronics without silver. Supply remains tight because primary silver production hasn't kept pace with demand for years. And now you're layering monetary and trade uncertainty on top of that foundation. That's not a recipe for silver collapsing back to previous ranges, unless something fundamental changes in the trade environment or in monetary policy. And I don't see either of those shifting quickly. If history rhymes and silver consolidates above current support levels, the move that follows could be significantly larger than what we've already seen. I'm not giving you a price target because I'm not here to sell you hopium. But pattern recognition suggests that when silver breaks out on structural catalysts rather than speculative froth, the moves tend to persist longer than people expect. And this looks structural to me. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Don't take my word for it or anyone else's. Markets reward independent thinking, not blind following. If you made it this far, you're the kind of person who thinks critically about markets instead of just reacting emotionally. That mentality will serve you well, regardless of what happens with silver or tariffs or anything else. If this breakdown helped you understand what's actually happening beneath the headlines, share it with someone who needs to see it. Subscribe if you want more pattern recognition content that cuts through the noise. And stay ahead of the curve, because that's where the real edge exists. Think critically, verify the data, and make decisions that actually fit the world you're living in, not the world you wish existed. Stay sharp out there.